Let's take a look at portfolio strategy as a corporate level strategy. To formulate effective strategies, companies must be able to answer these basic questions. What business are we in? How should we compete in this industry? Who are our competitors, and how should we respond to them? These simple but powerful questions are at the heart of corporate, industry, and firm level strategies. Corporate level strategy is the overall organizational strategy that addresses the question, what business or businesses should we be in? One of the standard strategies for stock market investors is diversification, or owning stocks in a variety of companies in different industries. The purpose of this strategy is to reduce risk in the overall stock portfolio, the entire collection of stocks. This basic idea is simple. If you invest in 10 companies and in 10 different industries, you won't lose your entire investment if one company performs poorly. Furthermore, because they're in different industries, one company's losses are likely to be offset by another company's gains. Portfolio strategy is a corporate level strategy that minimizes risks by diversifying investment among various businesses or lines. Just as in diversification strategy guides an investor who invests in a variety of stocks, portfolio strategy guides the strategic decisions of corporations that compete in a variety of businesses. Just as investors consider the mix of stocks in their stock portfolio when deciding which stocks to buy or sell, managers following portfolio strategy try to acquire companies that fit well with the rest of their corporate portfolio and sell those that don't. First, according to portfolio strategy, the more businesses in which a corporation competes, the smaller its overall chances of failing. Think of a corporation as a stool and its businesses as the legs of the stool. The more legs or businesses added to the stool, the less likely it is to tip over. Managers employing portfolio strategy can either develop a new business initially or look for acquisitions, that is, other companies to buy. Either way, the goal is to add legs to the stool. Second, beyond adding new businesses to corporate portfolios, portfolio strategy predicts that companies can reduce risk even more through unrelated diversification, creating or acquiring companies in completely unrelated businesses. More on the accuracy of this prediction later. According to portfolio strategy, when businesses are unrelated, losses in one business or industry should have minimum effect on the performance of other companies in the corporate portfolio. Third, investing in portfolios and cash flows from slow growth businesses into newer, faster growing businesses can reduce long-term risk. The best known portfolio strategy for guiding investment in a corporation's businesses is the Boston Consulting Group or BGC matrix. The BGC matrix is a portfolio strategy that managers use to categorize their corporation's businesses by growth rate relative to market share, which helps them decide how to invest corporate funds. The matrix, shown here, separates businesses into 4 categories based on how fast the market is growing, high growth or low growth, and the size of the business's share of that market, small or large. Stars are companies that have a large share of a fast-growing market. To take advantage of a star's fast-growing market and its strength in the market, a large share, the corporation must invest substantially in it. The investment is usually worthwhile, however, because many stars produce sizable future profits. Question marks are companies that have a small share of a fast-growing market. If the corporation invests in these companies, they may eventually become stars, but their relative weakness in the market, small share, makes investing in the question mark riskier than investing in stars. Cash cows are companies that have a large share of a slow-growing market. Companies in this situation are often highly profitable, hence the name cash cow. Finally, dogs are companies that have a small share of a slow-growing market. As the name suggests, having a small share of a slow-growth market is often not profitable. In sum, in contrast to a single, undiversified business or unrelated diversification, related diversification reduces risk because the different businesses can work as a team, relying on each other for needed expertise, experience, and support.